Hi, and welcome back to Investment Banking University's Investment Banking course. We're on the second side of the perpetuity, which is the sell side. This is typically associated with investment banking, which is the core focus of this course. So we are now to the how to become an investment banker methodology that we've created at Investment Banking University. So the following is the how to become an investment banker methodology. We're first going to begin with coverage, and this is going to be associated with index building from public companies. We're going to then use the index that we've created along with the data that we pull from it as the basis for a vertical report or a vertical newsletter depending on our coverage. That's going to help us in origination, which is the second step. We're going to run a target screen and origination consistent with our coverage, within our coverage. We're then going to have the relationships built with strategic and financial buyers within our coverage range, and we're going to do mandate target matching. We're going to talk about the methodology for mandate target matching. For those mandate target matching, it then translates into deal structuring for targets that are consistent with the hurdle rates for the strategic and financial buyers. We're going to aid in the buyer-seller meeting logistics, and then ultimately aid in framing valuation, which is done by calculating an adjusted EBITDA as well as a valuation. Then we are going to, after the targets valuation is consistent with the strategic or financial buyer's expectations, we're going to receive an LOI and a purchase agreement or an offer, and we're then going to do offer analysis. After that, we're going to aid in the shaping of the purchase agreement, drafting and structuring it, and then this is going to translate into the due diligence period. And we're going to help to set up the data room. Ultimately, we want to be on the flow of funds at closing so that we get paid, and that would be the culmination of the how to become an investment banker methodology. So in terms of coverage, we're first going to decide on the industry or industries that we're going to cover. We're going to read and research the value themes, players, multiples in the industry on the following levels: the large cap, mid cap, small cap, middle market, and lower middle market. So we're going to pick an initial vertical and sub verticals to cover. And so with Altquist Group, for an example, the boutique investment bank that I built, our initial coverage groups were the following. Number 1, manufacturing. Number 2, software. Number 3, business services. And then healthcare. So these are the industries that we cover at a high level. After choosing your coverage, the investment banker is then to build an index for each of these verticals and then sub-verticals that make up the vertical or industry. And then this is going to be populated with public comps. The Altquist Group coverage, after these industries that we cover the 4, we then break it down accordingly. So within manufacturing, we have durable consumer, non-durable consumer, aerospace and defense, building products, industrial, medical. And then within software, we have traditional software, SaaS, software as a service, and then internet. Within business services, we have education and training, business process outsourcing, facility services and industrial services, human resources, information services, marketing services, real estate services, IT services, and specialty consulting. And then finally, within healthcare, we've broken it down accordingly. Dental products, dental providers, medical devices and products, medical product distribution, specialty providers, pharma services, practice management, provider services, and long-term and behavioral care. So after we've determined our coverage, the investment banker then spreads each public comp, and the financial data feeds into the median and average for the vertical and sub-vertical, which ultimately ends up in the research. This is the industry report, newsletter, etc., as well as pitch books and sims of the investment bank. And we'll talk about what a pitch book is and what a sim is as well later on in the course. So for investment banks with an equity research department, financial statement models are then built for each public comp that is being covered, and consensus EPA data is taken from research reports, which will then be used to establish the value of a public comp. The investment banker ultimately uses the vertical index and sub-vertical index to perform proprietary research and develop industry reports and newsletters, which will aid in coverage and ultimately in originating engagements for the investment bank, M&A engagements. The research, which we will go into greater detail later on in the book and in this course, focuses on vertical and subvertical trends in margins, multiples, and in M&A transactions. So after establishing one's coverage and building an index for the vertical and subvertical, as well as establishing relationships with strategic and financial buyers within the vertical and subvertical, the investment banker may then begin advising targets on their strategic alternatives using information gleaned from the vertical and subvertical indices. Regarding the vertical index and subvertical indices, the investment banker is tracking trends in number 1, growth rates, number 2, margins, number 3, debt to equity ratio, and 4, multiples. So the investment banker takes the index and establishes tiers which turn into peer groups. And these peer groups serve as the basis for framing valuation for a given target. So this is why we pull public comps, to benchmark a target against the comps and derive a valuation. So by comparing a target's level of performance to its peers and the industry in general, the investment banker can determine when it's ideal to exit the business, when multiples are strong, and when it's not, when multiples are weak. This is how investment bankers advise on strategic alternatives. So in terms of just getting started in investment banking, for those just getting started, it's preferable to start with the lower middle market and middle market, building relationships with financial and strategic buyers as well as potential targets. This means building your Rolodex, obtain the investment mandates from the strategic and financial buyers, and establish a fee arrangement for buy-side deals. This will end up being the layman scale for the fee on the buy side. This is how I built the boutique investment bank, AltQuest Group. For example, with AltQuest Group, we chose to cover manufacturing. And if you're starting in the lower middle market, the goal is to get about 10 sell-side engagements at any given time. So it took me about a year to get 10 sell-side engagements, working approximately 40 hours per week and not on the weekends. So further, it's going to take you about 6 months to 1 year to close a deal. So stay proactive with originating and mandate target matching. To give you an idea of the level of productivity that you need to target, the following are investment banking statistics from year 1 with AltQuest Group. We sent about 3,000 introductory emails. We had 30 to 50 sell-side pitches on the phone and in person. 10 sell-side engagements were won, and then we received 4 IOIs from strategic and financial buyers. As you get better and establish a process, your email conversion rates and your phone conversion rates will go up, and your meeting conversion rates will be going up as well. And so you'll be pitching more, and your ability to win sell-side engagements will go up. So I am at a point now that if a seller is interested in selling, I will either win the sell-side engagement or I will structure it as a buy-side deal and receive the fee from the strategic or financial buyer. So looking forward to year 2, here are the projections. We're going to dial back the introductory emails to about 1,000. We're targeting about 40 to 50 sell-side pitches on the phone and in person. And then 20 sell-side engagements is the target. So we're going to have 18 existing, or 10 existing, and then 10 new ones. We'd like to have about 8 IOIs from strategic and financial buyers, and then close 2 M&A deals, which is going to, the fees, if they're in the lower middle market, or a little bit smaller than that, are going to total about 100 to 110,000 in M&A fees received. So the statistics assume that you'll be working about full-time at 40 hours per week and not working on weekends. So regarding fees, here's a simplified understanding of the fee structure for sell-side engagements. The key is to remember here that you do not make your money when you quote your fee. You make your money when you close the deal. The point is that I would rather win an engagement and give up 1 to 2% on the fee than have a seller think I'm not being fair. The layman scale simplifies this a bit, but it is oftentimes a seller will want to know the exact percentage that they will be paying you. So for large cap deals, it's going to be layman scale or smaller. For mid cap deals, definitely layman scale. The small cap, layman scale. The middle market is where we get into what's called the double layman scale. We're applying a multiple of 2 onto the layman scale. For the lower middle market, we're looking at a range of 3 to 10%, depending on the size of the deal, and we'll get into exactly what that means. So this is the infographic of the process that we just talked about, the how to become an investment banker process, starting with coverage, going into target screen and origination, mandate target matching, deal structuring, buyer-seller meeting logistics, calculating adjusted EBITDA, deriving a valuation, helping to structure a purchase agreement, doing an offer analysis, helping to put together the data room to facilitate due diligence, and then ultimately being on the flow of funds document to get paid. So that's it for this video. We're going to get into the middle market and what it is in the next video.